get started. We are hello everybody. We are absolutely delighted that you can join us today. We are very pleased to see such a large attendance for this event. If everyone turns up, and it probably is the case they won't, but if everyone does, we're going to be something in the region of about 175 people, of which many of these will be alternative managers from the US. So that is great news for us, but particularly since it's a fairly technical subject. But we see this as yet more anecdotal evidence that there is considerable interest in Europe from US alternative managers. And if anything, we see that increasing this year. We're not exactly sure why that is the case, but we are planning, I'll mention this in a second, to do some research before long to try and understand more about why this is the case. But it appears to be that more Americans are looking to Europe than in our experience we've seen before, and we've been doing this for quite a long time. And by the way, in this series, we have, with which we've been doing with Ocorion, we've had very strong attendance figures for all of them. In fact, even greater numbers than we have today. So this is not just a flash in the pan. My name is Simon Osborne. I am the CEO of IFI Global, which is a research and media house based in the City of London. And one of our 4 publications is called FSI, it stands for Fund Structuring International, which is for American managers when they're going offshore or coming to Europe. And as I just mentioned, through FSI, we plan to do some research in the near future on where US fund manager demand is coming from for the European market. In other words, the types of alternative managers that are looking to Europe, the structures they are using, the distribution channels they are using, domiciliation arrangements, etc. And then if all goes according to plan, we hope to turn that into a quarterly barometer, which we'll publish on a regular basis in FSI. So that's all I'm going to say by way of my introduction. I'm delighted we have on the panel today for this event, Gail Bowen, who is a managing partner at K&L Gates, who is based in Dublin. We have Stephen Hickey, who's the head of Ocarion's AIFM in Ireland. And we have Benjamin Lampings, the CEO of Reframe Capital. Reframe Capital is a go-to-market solution provider which helps managers in structuring product development and fundraising. And we have Paul Spendiff, who is the head of business development global funds at Ocorion. So I'm going to stop sharing screen and hopefully magically they will all appear the same size. Yes, they have. That's fantastic. So Ben, can I come to you first and ask you whether you, in terms of what you do from where you sit, do you see what we're seeing, an increasing interest, stroke demand from US managers who are looking at the European market? And if that answer is yes, why do you think in your experience that is the case?
Thank you, Simon, and hello, everyone. Thanks very much for joining us. Look, I have first-hand experience of this as a product lead for Nuveen as a very large US management organization. And so for a number of years, that perspective on how US investment capabilities fit in the European marketplace, but also more broadly. And I think the general narrative right now is that, of course, the fundraising environment is a challenging one. But I'm just going to touch on a couple of themes where we see today sort of an interest where US managers can sort of seize an opportunity. And I think I'm just going to talk in terms of asset classes. First of all, you may not be surprised that that's somewhat led by the impact theme with renewable energies, and that includes non-traditional energies, and as well as battery storage, energy transition, hydrogen, carbon capture. That's somewhat relevant for US managers, particularly because of legislative changes that are going on in the US market. The Inflation Reduction Act has really broadened interest to US strategies due to subsidies, where in the UK and Europe, there are challenges as of today, and that can make it relatively attractive. I think there remains demand, as many have seen, for most forms of debt, including real estate. They remain stable, but they are trending towards senior at present because of uncertainty in the market. There is a general view on preference for floating rate deals, even in segments of the market like real estate, where there have been normally fixed rates. I think tech, logistics, healthcare, they're continuing to show positive trends. But on the wane, we see real estate, logistics, offices, and particularly where the US dollar has obviously been seen as expensive relative to the US pound, pound sterling. But of course, that is starting to normalize somewhat at the moment. A point to make on European investors, they're somewhat sophisticated when it comes to capital structuring. So woolly statements around this area will really not be well received. And just to touch on leverage, that will be expected to remain actively managed and start very low in the current market environment. That's really what we're seeing at the moment, Simon, in terms of asset class preferences.
Thank you. And Gail, can I bring you in? What type of structures do you see that American managers are most interested in when they're looking to come to Europe?
Yeah, so it really isn't a one size fits all, and depends on the asset class, and there's various other considerations as well. If I was to be very simplistic about it, which I probably shouldn't be, but if I was to be, I would say alternatives, hedge funds typically go into an ICAV type structure, and they would all be set up, I would say, as quafe funds, which are for sophisticated investors and are very flexible, can be set up in a 24-hour fast track authorization, but are only available to what we call qualified investors. That's slightly different and broader to a professional investor, it should be noted, but it does encompass sophisticated investors coming in. On the private fund side, I would say their preference would be around a partnership structure. And that's just, I guess, investors in that world are more familiar with that vehicle. And there can be certain tax advantages to using that vehicle as well. Outside of that, the other factors I would say are investor preference and the types of investors that you have coming into the funds. And that often drives the type of vehicle. We talk about European funds for the European market, but European funds are sold in Asia and other jurisdictions as well, it should be noted. And Asian and particularly Japanese investors will prefer a unit trust structure. So often when we see US managers targeting those markets, that's what they will typically look to set up. So various different considerations, and depends on the asset class, the types of investors, and the domicile of the investors coming in as well.
And as we discussed in our prep call, I think I'm right in putting it this way, I hope. It's not the case, or if it ever was the case, it's no longer the case where US managers can easily or relatively easily use existing fund structures domiciled in Cayman or indeed Delaware. As we said, I think on prep call, I don't know of any Delaware fund that's ever been distributed in Europe, but certainly many Cayman funds have been distributed in Europe over a very long period of time, particularly from the hedge fund world, but in other categories too, private equity, etc. Are we at the point in time, or have we already reached the point in time where it's really, are you saying, even to a manager that wants to stay offshore, that is really not a very wise idea to try and use a particular structure and domicile for accessing professional stroke institutional investors across the European market?
Yeah, so I would say you're right. In the past, a lot of managers have tried to stick with their existing offshore structure. What I would say is typically I have seen Cayman funds more sold to the US market and the Channel Islands more sold into the European market. So I suppose if anyone was going to continue to try and access that market, it would be the Channel Islands. But then you can't rule out, even when you're typically targeting US investors, that there will be a large European investor in your Cayman fund structure, and you have to source out a good proposition for them. So a lot of them did in the past try to manipulate this fund and sell it into the EU. I think a starting point was reverse solicitation, but I think everybody has pretty much accepted that that's not really that's a very risky route to go down, and it's interpreted completely differently in each jurisdiction, with some jurisdictions just not permitting it at all. So I think that has dissipated now. Some have tried the national private placement regime, but I think it's fair to say when you're dealing with a European investor, and depending on the investor, most of them will require a regulated fund structure for various different reasons. AFMD precludes them coming in quite easily across the EU and marketing into each of these jurisdictions. Even if they do register under the MPPR, they have distribution issues selling it through their own sales channels. And then the main blocker, I would say as well, a lot of European investors for tax reasons simply cannot invest, or it's not efficient for them to invest in these offshore structures. And then I suppose things haven't been helped with grey listing issues in some of these jurisdictions as well, making it very difficult, I think, for European investors to come into these structures. So managers have tried to repurpose these vehicles. You could never get a passport. Now, maybe in the future, down the line, it is envisaged that the AFMD passport could open up for these structures, but we've no sense at the moment as to if and when that will ever happen. And as a result, I think most managers now have accepted, if you have strong potential in the EU, or you want to raise capital in the EU, trying to repurpose and restructure an offshore fund to do that is probably not the right way to go about it, and will cause you issues in raising capital with European investors.
I will just jump in here, Simon, to say that like so many of these decisions are importantly influenced by your distribution plans and your distribution strategy, who you intend to target and what their requirements are. And that's why there's an important stage of planning that really precedes in council starting work on a fund setup to identify your target market. As Gail has already alluded to, there are tax considerations, regulatory considerations, investor preferences. Tax plays an important part for US managers that want to operate on a cross-border basis, because you've got certain types of investors who are tax exempt, others are taxable, much like the US system. But the reality is that some of these European investors would have issues being subject potentially to IRS taxation. And so there are needs for a very clear tax profile of a particular fund that can really dictate the structure. And then you're looking at the particular vehicles and investor preferences across the various jurisdictions that Gail has mentioned there. You've got the Channel Islands option, you have Ireland, which is certainly a growing jurisdiction for private market managers in terms of optionality of structures that are available. And Luxembourg, of course, is that well-trodden path to for private market managers looking to establish a presence and build out their footprint in the European marketplace. And then looking beyond Europe, with structures that then can be suitable for broader cross-border distribution globally.
Yeah, I think before we move on, we're going to move on shortly to legal structures and talk about that in a second. But I just want to confirm, clarify something particularly Gail said. I just want to make sure this is the correct interpretation of what you were saying, Gail. Are you saying for most European, you said investors, you're talking, I presume, primarily institutional investors, the pension fund community and so on and so forth. You're saying a regulated product domiciled in the EU, whether it be in Ireland or in Luxembourg or wherever, is the way most alternative private fund managers from the US are now going. Because I wanted you to clarify that, because we've always thought, from what we see and when we're doing our research, etc., that using private placement arrangements, particularly in the markets where private funds are after big institutional money, which is typically the Nordic region, the Netherlands, of course, Switzerland and the UK aren't even in the EU anyway. That will cover a large chunk of your market, and you're going to save quite a lot of money by not going to the final degree of being in Dublin or Luxembourg. Do you want to comment on that? And indeed, is that Stephen? Anybody else want to comment on that as well?
I'll just clarify what I was saying on that. So particularly in the alternative space, more so than the private fund space, it is driven by where the investor is located. So where I've seen this issue crop up, if you French investors, Nordics, or Italian-based investors, I've seen that having an offshore fund trigger tax implications for those investors. If you're in the UK, for instance, I see less of an issue. So depending on where the investor is based, but certainly with those jurisdictions, I think it can be quite problematic, even under the national private placement regime with an alternative fund structure. I've seen a French investor, a manager having to re-domicile their fund from the Cayman Islands into Ireland as a result of a tax implication for, I think it was a French investor in that instance.
Right.
Yeah, I think, Simon, just on that, that for when it comes to our clients, they're probably two of the key questions are: where are the LPs, where are your investors? And as just to back up what Gail says, because that's going to have massive tax implications on them. And then also going back to Ben's point a couple of minutes ago, your distribution plan. Where are you planning on distributing this fund is absolutely fundamental to your jurisdiction choice and the structure that you're going to go after.
Fair enough. Okay, well, that's clarified. Actually, no, sorry, one last thing before we move on to legal structures. I've heard rumors, I don't know whether you have heard rumors on this, that reverse solicitation is getting ever more difficult, particularly after the EU brought in its cross-border fund distribution directive. It's still there right now. I've never heard of a manager, whether it be American manager or any other manager, being hauled over the coals for using reverse solicitation. That's always been the threat, because they normally have very good law firms to make sure that doesn't happen. I'm sure K&L Gates does a lot of work in that area, at least from your New York office probably. But what's your view on things like reverse solicitation before we move off the subject of this domiciliation, because that would avoid you having to be in the EU as well?
Yeah, what I'd say, and this comes up a lot, everybody gets nervous about reverse solicitation, but nobody's ever been called up for it. So what is the risk, I guess? What I would say on that, and again, it's country by country, you'd have to go and check each local jurisdiction. Some jurisdictions rule out reverse solicitation completely for certain types of investors. So retail may not ever be able to go into it. Semi-professional in Germany, even though they could go into an alternative fund, could not rely on reverse solicitation. So that's something to be mindful of. In terms of the consequences of it, really, I'd say it's not that a regulator is necessarily going to take somebody to task over it, but if we were to have like another decline in NAV situation, a very serious global issue, and the NAV was to decline, and an investor made a complaint and said, actually, you marketed this fund to me and you shouldn't have, they would have a claim in most jurisdictions that the transaction was voidable. And what that would mean is that the fund manager, if this investor was successful in their claim, if they could not clearly demonstrate and they had documented and shown that this investor had initiated the contact, they could have to put the investor, restore them back to the position that they were in prior to the investment, which would be quite a serious implication. So I guess it's for managers to decide how realistic or reasonable it is that would happen. The other thing I would just mention, some jurisdictions take quite a serious approach to breaches, and I know in Italy it's a criminal offence to breach the regulations, because we were looking at this for a number of clients who operated in a few different jurisdictions, and Italy, I would certainly say you'd want to be very careful with. So you're right, I don't think necessarily a regulator is going to call anybody to task, but you have to just think, if there was a crisis down the line and you couldn't clearly demonstrate and you got an action that you had, that this investor initiated the contact, so I mean having written confirmation from them, dates as to when they approached you, how they made that approach, I think it would be quite a risky situation. And then just under the cross-border fund directive, distribution directive, what I suspect you are alluding to there, it was a double-edged sword. They brought in this pre-marketing notion, which suggested, oh, this is great, I'm pre-marketing, but you still do have to notify. And then if somebody comes into your fund during that period, then you must register. You won't have a choice.
And I think it's 18 months or something, isn't it?
Exactly, it's 18 months. Now, I still think that's a better situation, because if you think about it, you don't want to register with no investors coming in. So at least the triggering point for the registration is going to be money coming into your fund. So that is, I think, a positive development. But if you go under it and someone comes into you, you absolutely have to register, and you would not be able to claim reverse solicitation. And I suspect that's probably the issue that you're referring to there.
Yep, but the other side of that 18-month window as well, Gail, is that if you don't receive investors into it, the strategy is almost null and void for the period.
Yes. Yeah, that's the other side of it. Yeah, it is double-edged.
I think maybe we should make a distinction though between, there's obviously open-ended funds, so evergreen funds, we particularly see those in credit, and closed-ended funds. And if you're in a closed-ended fund, obviously you're looking in the here and now, you can have a 6-month, maybe a 3-month pre-marketing and then a 3-month marketing period. And perhaps you can take a view, can I rely on reverse solicitation at this point? Can I get away with under the national private placement in markets like Switzerland and the UK and perhaps some Scandinavian regions? Though I note that Swedish pension schemes been forbidden from going into anything that's not European funds that are Article 8 and 9, for example. So it's 150 billion off the table. Let's assume your market, it's a follow-on fund. I think you can make that judgment call. I think particularly when you're looking at evergreen funds, then the thing is you're trying to pre-guess what might come in AIFMD2, which is due in 2025. You're trying to second guess what regulatory changes. You're trying to, can you be guaranteed that the domicile your fund is, let's say Cayman or Jersey, might not go back onto the naughty step. So I think I think at least with the closed-ended funds, you can make a judgment call which says, okay, do I genuinely think I can get this away? And if initial conversations with my investor base say, no, it has to be onshore, then you can look at a parallel vehicle, some form of paralleling. But at least you've got that option. I think when you go for an evergreen fund, and as I say, we don't typically still see them, obviously in real estate, etc. these days, but actually in credit and a few other sort of types of asset classes, I think you have to make that call. Am I comfortable this is fit for purpose for the next 5 years? And I think if you're making that call, it's really difficult to make the decision to go offshore, and that sort of fund shouldn't be onshore. So I definitely think there is that caveat to consider. Right.
Thank you for that. But we're going to move on now. Before we do, I should have said at the beginning, we will try and allow, I see there's a question that's already come in. We will take questions. We'll probably leave hopefully about 10 minutes at the end for questions. Please do use the Q&A button at the bottom of the screen should you wish to ask a question, and we'll endeavour to answer that today. If not, we can come back to you after the session is over at some point in the near future and answer it if we run out of time. So let's say, for the sake of argument, I'm an American fund manager. I've considered using my Cayman structure. I've decided, I've listened to Gail, I've listened to the other people on this panel. I've decided that's not going to work. I'm going to do the full Monty. I'm going to come into Europe, Fortress Europe, welcome in. We're going to go to either Dublin or Luxembourg. We're going to do it. What are the next steps? So let's say we are looking at Dublin, particularly since there's such a strong Irish-American connection. Steve, can I come to you now and ask you, when you have these conversations with US managers, they're looking principally at this particular point in their decision-making process at setting up within the EU and picking Ireland. What are the typical things that you go through? What are the next steps?
Yeah, I think probably, as I alluded to earlier, Simon, the key distinction for us is going to be where the investors are domiciled. And a lot of that is down to tax implications. So we would hope that clients coming to us would have an idea of where their LPs are going to be situated, and then discuss that with their tax advisors as to what would be the best course of action for them. Also then, of course, you're looking at the distribution plan. You know, where do they want to market these funds? Where are they targeting those institutional investors? So off the back of that, then we need to, I suppose, and probably Gail will speak to this a bit better than I do, but we'll talk to, you know, the type of fund structures that are out there and available to our clients once they've considered Ireland as their domicile of choice. So, you know, as Gail mentioned earlier, the main fund structure is a qualified investor alternative investment fund, and that they can take, you know, various forms. One being a QUAIF, one being the ICAV or the ILP, which is the new regime, the limited partnership regime in Ireland. They're probably the main structures that we'll be looking at. I suppose the ILP regime change, which Gail was a large part of here in Ireland, was bringing ourselves up to and trying to get on a level playing field with Luxembourg. So we're hopefully seeing a bit of a move towards that structure, and hopefully that our clients in the US will be looking at that structure going forward. So there will probably be the key questions I'll be asking clients when they've made the decision to pull the trigger on a certain jurisdiction.
And do you, do they share their distribution plans with you, and then is it something you can advise them on and help them with?
Yeah, absolutely. I mean, as if they're looking to appoint us as their AIFM, we would definitely be part of that distribution plan. As part of the AIFM designated person responsibilities, we have a person designated to distribution, and that would be someone within the AIFM. So we'd be very close to the distribution plan, the jurisdictions that they're looking to enter into, how we register in those various jurisdictions, and that can all be done upfront and after fund launch also.
Gail, have you any thoughts on the process, and is this the right time to bring in the subject of the Central Bank of Ireland and the authorization process that one has to go through to get up and running in Ireland?
Yeah, and I guess worth mentioning, I suppose with K&L Gates, we've such a strong presence in the US. We're often involved in very early discussions with managers who are looking at optionality around raising capital in Europe. And I guess we would be jurisdiction agnostic because obviously we've a Lux office and an Irish office, so we would get involved in discussions with them. In terms then, I guess, of when they come to Ireland, how you would set up, because obviously that's the jurisdiction I primarily deal with. What we would do, I mean, there's a few different routes, and it depends on how they want to structure it. I mean, they can, if they're confident that Europe is a key market for them, they can look at redomiciling and moving their fund product over into the Irish market. And I've done a number of redomiciliations from Cayman, and I've done BVI and Guernsey and Jersey as well. So I've covered quite a few jurisdictions. Some managers do it by way of scheme of arrangement or scheme of amalgamation, a merger. Parallel structures is popular. There's all different ways in which it can operate, and master and feeder structures as well, although that is less commonly used, I would say. It tends to be one of the other options that managers tend to avail of. If setting up in Ireland, again, so the first thing we would do, as Stephen said, obviously we need to understand where the funds are being sold, because that's going to dictate the type of structure that they use. Most cases, nearly always, it's a QUAIF, so it's quite a flexible structure and it's going to be set up very quickly. The most popular QUAIF would be,
sorry, may I just interrupt? How quickly is quickly? Is that comparable with the RAIF in Dublin?
Yeah, exactly. So. Yeah, so just in terms of the setup, it is quite comparable. So for those who aren't familiar, the RAIF product in Luxembourg is a somewhat unregulated fund, but it can avail of the AFMD passport, and it has an AIFM appointed to it. And in Ireland, we have the QUAIF structure, which is a regulated fund. So it is an authorised fund by the central bank. But the beauty of it is the regulations are more infrastructural around the service providers and the framework, but it's quite flexible. There's no leverage restrictions, no investment borrowing restrictions. So it's quite a flexible product that can set out to market, and we can set them up on a fast track authorization process with the central bank. Now, I probably don't want to quote this live on a webinar, but I have done them in 4 weeks.
Right.
Don't like having to set them up that quickly, but
yeah, we heard that. That's gospel now, Gail. 4 weeks is the minimum.
Yeah, you got that out, Gail. Yeah, you
I mean,
can't.
the reality is that I think in the past, it was often the case that the regulatory process tended to drive the timelines for launching funds, but it's not the case today, where regulators are far more aware of that need for managers to get to market within the shortest possible time frame. That's why there's been such huge success with the reserve day regime in Luxembourg, and it's been a successful regime. But of course, the evolution in the Irish market with the Irish ILP today levels that playing field, where the process is often driven more by the service provider integration, the setup, and other steps outside the regulatory cycle that now dictates that time frame. So whilst, of course, it's very easy to have up in lights that approvals can come within days, it's not realistic for any manager to think that from scratch you can be in the market with a live fund that is investable within a month or 2 months. Those are breakneck speeds, and you compromise in many ways to get to that place. A realistic time frame is still 3 to 4 months to have a fully functional fund.
Even
with
for a quaif.
Even for a quaif.
8 weeks for a quaif. I would allow 8 to 12 max. They're very.
You're talking about pull the trigger. Obviously, there's a lot that you've got to pick your jurisdiction, select your service providers, put together your marketing plan, so how your distribution plan.
Exactly.
And that's how this can run concurrently with your application, right? And then obviously there's the thorny issue of opening bank accounts. But so I think yes, from the pure regulatory piece, I think 8 to 12 weeks, 8 to 10 weeks is absolutely the right number in terms of, okay, pull the trigger. We've selected our onshore and offshore counsel. We know our service partners. We know where we're going to market, distribute the funds. We know we want to do pre-marketing. Let's go. I think obviously that's got to be added onto the front end. And I think to rush that or skip those, and Ben, I know you've experienced this, is where people have sort of skipped that and then tried to almost retrofit that into the structure. And then what you end up doing is getting to the point where you're suddenly going, no, we're having a change in domicile because actually our cornerstone investors decided that it has to be in Luxembourg or Ireland or somewhere else, the UK. And so suddenly you're tearing it up and starting again. So I think, yes, I think 8 to 10 weeks is absolutely the right number. Realistically, it can be quicker, but in terms of the actual, regulatory bits, I would say, and legal bit, but in terms of the actual project, I think that probably looks nearer sort of 4 to 5 months with a solid sort of 6 to 8 weeks before you get to that bit where we would go. Where I would say you're pulling the trigger.
Absolutely.
Yeah.
I think it falls into two spaces, really, doesn't it? Operational practicalities and the decision-making process up to that point, and then it falls over into the regulatory space. So, if you're looking at your fund documentation, your service provider appointments, your agreements, these all need to be copper fast and done to a level and a standard that is, at a place where you're confident going to, say, the Central Bank of Ireland and looking for their 24-hour approval process, that all those I's have been dotted and all those T's have been crossed to a sufficient standard.
And bear in mind that it doesn't stop there, because of course if you're targeting institutional investors, there can be a very rigorous operational due diligence process, and the extent to which there are seen to be compromises in that infrastructure in your organizational governance, then those can represent red flags and impediments to your fundraising process. So it's right to consider certain concessions, but equally, I think you cannot compromise on suitability and fitness for purpose.
And what I'd say as well is, when you're talking about due diligence, the AIFM and the service providers in Ireland will do due diligence on the clients as well. And they don't always have all the information ready to go, and that can take a little bit of time as well. But in terms of once you have selected your service providers, and we can assist in that process as well, we often have a look at, what's the asset class and who would be a good fit for particular clients. And usually they'll pick a few providers in the market and have a look and assess them. But once that part is done, I think it's quite a quick product to set up for market.
I guess one of the things we probably haven't touched on yet is the regulatory status of the investment manager or the client who is looking for appointing an AIFM or an administrator or launch the fund. So depending on their regulatory status, they may need to be registered and authorised with the central bank, and there's a process in itself for that.
Right. By the way, whilst we're on the subject of the quaifs, I was very interested to see very recently, meaning only a month or two ago, the CBI has allowed CLAVES to invest in digital assets. I don't know if the RAFEs, you can do that in, or how you can do that in Luxembourg. You may know that, Gail, I don't know, but that was interesting to see.
I'll just mention what it was that the central bank did. So basically the central bank issued guidance now that says it's an indirect investment, and I probably should just qualify that. So if you're indirectly investing in digital assets and the exposure is under 50%, you are able to set that up under the 24-hour fast track, and they're not going to scrutinize it. So that product, that's quite a significant development, and you can house an investment in those asset classes quite quickly in a European regulated structure. My understanding with Luxembourg, but I'll defer to those who might know better, is that I think you do have to make a pre-submission into the CSSF. It's not that they won't allow it, but I think they'd like to consider it in a bit more detail before they'll authorise it.
Yeah, also it depends whether it's, yeah, sorry to interrupt. Yeah, I think Luxembourg also depends whether it's the primary focus or whether it's it's simply a small part of your strategy. There is the Luxembourg have allowed for, there is in the CSSF in Luxembourg, when you apply for a license with an asset, you actually apply with specific permissions, unlike the UK or Ireland, where you may need to demonstrate expertise in that, but there's not actually a specific license. So there's an infrastructure license, there's a hedge fund license, there's a private equity license, real estate, and so on. And Luxembourg have issued have said that you therefore require a specific license covering cryptocurrency if you wish to invest in that. To date, and I'm sort of not 100% up to date, I don't think they've issued any licenses, though I believe that some overseas managers, so particularly German managers, are using their licenses from Germany to run crypto funds within Luxembourg. But it's definitely, I mean, it's an ever-changing landscape, certainly with that regard. But I guess watch this space.
Yeah, just sorry, I was just going to say, we're hearing now since the CBI opening stance on it, quite a few people have been in touch and been very kind of interested in what that stance looks like. So it's definitely a space that's evolving quite quickly.
Yeah,
and I think a discussion just on jurisdiction to round off. It wouldn't be right not to mention the word Brexit here as well, and that post-Brexit, US managers that are considering pan-European distribution really have to look at the UK on a standalone basis. But it would be wrong to dismiss the UK as a target market, given that it remains the second largest investment centre globally behind the US. And so in terms of pensions, insurance opportunities and wealth opportunities, it remains very, very much a compelling jurisdiction. But those looking to gain market share in the UK today really must consider making a commitment to onshore use of onshore and domestic structures and solutions.
Yeah, funny, sorry, Simon. We just commissioned, as a Corian, just commissioned a piece of independent research about capital raising, and we surveyed 100 firms. 50 of those were in the US. And if you looked and said to them, where are you focusing to, outside of North America, and the UK and the Nordics were top of that list, worldwide. That wasn't just, in sort of Europe.
Yep.
And then you say, well, and where are you entering for the first time? And again, actually, it was Nordic in the UK. So it was, it was going to be a target, and for a majority, it was going to be a target for the first time. So I think, and bearing in mind, again, Switzerland, and the UK, you could apply the national private placement or have a domestic fund. I think it's definitely, as we said, ultimately it boils back down to our original comments, which is, you're going to be investor led. If that, because I think, there is no silver bullet. There is no magic fund that's going to suit all investors. I think there was a question about, well, if it's a unit trust, does this not sort of create a tax issue? There's no magic bullet for this. It's really trying to create the biggest pool of capital based on your relationships and based on your relationships and based on your distribution capabilities and where they have demand and where they need that fund to be, and that will ultimately lead you down a path where there may be one or two options, Luxembourg, Ireland, Malta, even where, but ultimately you're going to end up at a place where, you're led there by your investors rather than sort of, necessarily driving that from where you or perhaps would like to operate from.
Thank you for that, and that's a good point. I mean, your research sounds fascinating, and you might want to say a bit more about that before we finish this, Paul. But the one country we haven't mentioned really at all today is Switzerland, which is the second and has traditionally always been the second largest alternative funds market in Europe. You mentioned the Nordics, well, of course, Norway is outside the EU, although it's not the biggest Nordic market, but has one of the largest pension funds in the world, one of the least sovereign wealth funds, I shouldn't say pension fund, and one or two large pension funds as well. So that point is very well made. Time is galloping on, and we haven't got a huge amount of time left. I'm going to try and combine one or two things we have on our sheet here. I do want to come to selection of service providers. Gail has touched upon it, but perhaps can I alter the order, because I wanted to bring up, we haven't mentioned ESG yet today, and I've been well, we have a publication called the ESG report. We've been doing a lot of work in terms of looking at the risk of investing in ESG at the moment, and during that process, we've discovered there are roughly speaking, around the world, I don't know how many of these are in Europe, there's 2,000 cases of investors and special interests taking various entities to court because they're not meeting their ESG obligations. And then we've just seen recently, when we come across this very recently, litigation funds that have been launched to make sure that, you know, people are doing what they're saying they should be doing on the tin in terms of their environmental obligations. Of course, we have in Europe the SFDR. And what do you want to tell, perhaps Gail, we should probably come to you first, but please, particularly Ben as well. What do you tell Americans? It's so different over there, the whole year. And I know I partly live in the States, spent a lot of time there. It is hugely different what's going on in Europe and what's going on in the US. What do you tell, not so much the managers that are going for Article 8 or 9 funds under the SFDR, because that's a separate ball of wax. What do you say to a non-ESG orientated US manager coming to Europe about your environmental obligations today?
Yeah, maybe I'll kick off on that. So I've only recently discovered the ESG issues in the US, which are so, I thought we had a mess in Europe, but when I hear what's going on in the US, it's just very different. I know there's anti-ESG boycotts going on in the US. So we're at polar extremes, I suppose, in terms of what's happening. What I say to managers, I suppose, is to be very careful with their classifications and to be quite conservative. And a lot of managers tend to, particularly from the US, they'll come in and say, I'm Article 9. And then when we really get into the weeds on it, we find out it's not that they don't have a sustainable objective or are trying to achieve sustainable goals, but it's a very difficult and rigid framework, and there's quite a lot of complexities, and there's a lot of uncertainty at the moment as to how you even achieve that. So that's one thing that I would flag. The other thing I would flag is it depends on where your investors are based. So ESG and SFDR classifications can be important in Europe. They don't seem to be important in Asia. They don't really seem to care what the ESG classification is. And I would say I act for a large Swiss manager, and I think, and a lot of my funds are sold in Switzerland, it doesn't seem to be very important to Swiss investors what your classification is. So before you start down this track of, you know, aiming for one thing or the other, is it really what your end investors want? And is it worth really the pain of trying to achieve it, because it's quite a rigid regime? And then just finally, on those with non-ESG strategies, what often I hear them say is, I'm non-ESG, but I really want to say that I am thinking about the environment, or make some sort of statement. And the central bank has been very clear, if you're non-ESG, you do not make any statements at all that could be considered greenwashing. So they'd be, I suppose, the starting points for conversations with managers.
Yeah, Steve, Ben, Paul, do you want to say anything about ESG, particularly the differences, which are massive, as Gail says, between what's happening in Europe and the States? In Europe, it's all about regulation. In the States, it's all about lawsuits, basically. The good old Americans love their lawsuits.
Just really,
well, it was an interesting. Sorry, Stephen.
Sorry, Ben. I'll be very quick. Just the key things for me, the key risks around it are data. I mean, that's a key issue, getting the right data, the correct data, and managers being able to assess that, and then off the back of that data, being able to make informed decisions around the, I suppose, the disclosures that they're going to make in their fund documentation, and to be really, really clear on the point of those disclosure pieces, because as Gail mentioned, the key risk for all of this is the danger that you move into that greenwashing area, which obviously is a key thing for regulators, and that they're keeping their eyes on. The central bank had when we were at the Irish Funds Conference last year, it was a key point of note for them. And again, it's on the agenda again for this week when we go to the Irish Funds. So it's a real key topic of review for the regulator. Sorry, Ben.
No problem at all, Stephen. And look, I thought it was a really useful point that Paul made on the target investors for many US managers being in the Nordics and the UK. And I would say that those two territories are probably where ESG and impact standards and the sophistication of investors is greatest. And what we're not just talking about here is SFDR compliance with the tick box exercise. It can be done, it can be adhered to, the disclosure requirements can be met, and managers can be guided on the risks of greenwashing and how to mitigate them. But having said that, investor standards diverge from those regulatory frameworks. Investor standards in the UK, as an example, align with stewardship codes and responsibilities where ESG and impact requirements are now part of fiduciary duties. And this is where that divergence, to some extent, really comes out as between the US or certain regions of the US and in Europe, because in our case, they are codified and incorporated, and the investors must discharge that duty to invest only in products that meet certain requirements, whilst in other territories, perhaps in parts of the US, there's a requirement to discount that very specifically. So managing that, trying to achieve a harmonized investment process and operating model can be very challenging. But I guess the point that I would raise is that if you are targeting investors in the Nordics, in the UK, you must take ESG and impact standards very, very, very seriously. They must be integrated not just at a product level in terms of labeling, but they must be incorporated within your investment process and at an organizational level. And the reporting, and Stephen mentioned the challenges with obtaining reliable data and then reporting on it. The key is to be transparent about what you use, how you use it, the methodologies you follow, and ensuring at all times that you can demonstrate that ESG or impact application within your investment process.
Just one word answer to this question, Ben, because we're really galloping ahead of the time. Even if your fund has no interest in promoting itself at all in any shape or form, in any way, as a sustainable fund, an environmental fund, an ESG fund, call it what you will, that still applies.
So you look at this as a pool of capital that's available and addressable, and you simply will find that certain mandates, LGPS schemes in the UK, so that's local government pension schemes, for instance, now must adhere to certain impact and ESG criteria, and the extent to which strategies are not meeting those criteria, those strategies cease to become eligible for those types of investors. So coming back to our original part of the discussion, your target market, the investors that you intend to approach, it's absolutely key to understand what conditions they're subject to, what requirements they have, and meeting them. And in some instances, you may be making concessions and limiting your ability to raise capital in certain client channels, but in other cases, the strategy may well still represent a good fit.
Okay, thank you. In the very few minutes we've got left, I'm going to come to something I would have loved to. Sorry, we didn't get to this earlier. What are the common what are the pitfalls? What are the pain points? What can go wrong? I'm sort of galloping over selecting the service provider, but it's one of our bullet points here too. I've often say when I introduce these events, it's easier actually to change your life partner than it is your service provider when you're setting up a fund. So how do you go about selecting your service providers, and what are the other issues? What are the other pitfalls? What are the things you need to look out for?
Perhaps as someone that is involved in that process for selecting vendors, I can comment on the fact that their understanding and expertise of the asset class, of the strategy type that you run, is absolutely critical. I'm sure plenty of the US managers on this webinar today have established relationships with vendors that operate cross-border in different territories, and the extent to which they can harmonize those operating models is always favorable. But I've been in organizations where there is an attempt to shoehorn that type of relationship into structures, into new markets, into supporting a business in a different territory, and that doesn't always work. So having an open mind about using the right service provider for a particular product structure for a particular market is important. As we've seen the evolution of structures in the hybrid investment world today in private markets, there is a need for expertise of your vendors because they come with a whole host of operational challenges and complexities that a failure to understand that can often lead to very significant operational risks inherent in the way you're setting things up. So I would say that that's vitally important to ensure at the outset of engaging with your vendors. Pricing is always a key consideration, but you've got that manager's dilemma. It's cheap, it's fast, it's good. What do you prioritize?
So
yeah, but also I think when we did our research, I mentioned that research. Yeah, we found out that, which is down a little bit from maybe the classic number that was always touted around, which was 70%, but 55% of our US respondents still did their administration of their Delaware vehicles or Cayman vehicles in-house, right? So if they're coming to the Europe for the first time, not only have they not got a partner, they're potentially, they're entering for the first time into an outsourcing model of administration. That's challenge number one. Two, they're then saying, okay, well, how if I'm running potentially a parallel fund, if I continue to wish to do my domestic vehicle myself, how does that dovetail? Bear in mind these are going to invest parallelly into a parallel vehicle or into pooling vehicles underneath. How does that operate? How well can my fund administrator engage with basically my internal processes, right? And then you're saying, and then there's this new thing where we've never had a depository. We've never had an AIFM involved in our investment process, in oversight. So how does that work? How does Steve's team, for instance, as the AIFM, engage with us? What needs to change, if anything, in our investment management process, in our due diligence process of our assets? How do we have to show verification of ownership for the depository, for instance? So these are all new things for US managers in particular, because they've got this sort of more in-house model. Now it's changed over the years, and often when we onboard new clients, we'll onboard perhaps the Luxembourg piece, and then the conversation will go, actually, do you know what? We're now realizing potentially that there's a bigger picture here. Can we have a conversation about our US piece? But I think, certainly initial discussions are always around how is this new vehicle, this new product in for us in this new jurisdiction going to dovetail with the minimum of impact and friction with our existing business model? Steve, maybe that's you can segue to that.
I think you hit the nail on the head, Paul. I think obviously it brings a great deal of additional risk to the manager. So we're talking regulatory risk, we're talking operational risk. And the best way, you can minimize that is ensuring that your outsourced service provider selection is absolutely on point. And then the ongoing lines of communication are there and consistent. You want to make sure that your outsourced providers know the investment process, they know investment restrictions, how that's going to interact between the manager, the AIFM, and then the AIFM's relationship with the depository and the administrator. Also, that we have clear communicated SLA, SLDs in place, that they're monitored, that the relationship is ongoing. Because as Simon says, it's a hard thing to unravel, especially when you're going into investment vehicles with closed-end structures of up to 10 years. You really need to be thinking about 3, 4, 5 years down the line.
Now we have, as I said many times already, our time is really against us. I'm going to come to the killer question of the whole event today, coming up right now, and remind those in the audience that we'll try and save a couple of minutes for questions at the end. I see there are 2 there right now. Please do, if you want to, try and send something in the next couple of minutes. Here's the killer question. I think, Ben, you may be a good person to come to first, but then everybody else chip in after that. What is the realistic cost of doing this? And of course, we've been talking about different structures in different ways and so on and so forth. But if we're talking about doing a quaif in Dublin, for example, which I think many people listening to this may be considering as a possibility, just give us a range of possible costs for the kind of things that you're talking to your clients about, you coming across on a day-to-day basis.
Budgeting is always critical. And for me to give hard numbers here and now, I don't think it would be meaningful. But I will say as a broad point that your budgets are absolutely critical to look at all of your vendor costs and the commitments that you make up front, but also what costs are attributable to the manager as part of the setup, where that gets assigned as part of a setup charge, versus those costs that are attributable to your vehicle and then are borne by investors. Of course, you can't simply think, well, it will push into the fund as much as possible, because you're diluting your returns in that respect, and that's harmful overall to your proposition. So I think having a very clear economic model of what you as a manager need to commit to, and then of course what your investors are likely to bear, is absolutely critical, and needs to be determined at the point at which you're marketing your product, because investors will ask those key questions. What is your cost base, and what are the charges that we will bear in the fund? Now, what I would say is that we've seen in trend terms that operational expenses of a fund are normally subject to caps, and that just gives certainty to investors. Over the last couple of years, there's a general trend for those caps to be increased, which is a sign that service providers are obviously bearing additional resourcing costs, headcount costs, service costs that are being passed on to investors. What I will say also in terms of price sensitivity is that, of course, when managers are coming, they look at that lowest price point. What is the smallest commitment we need to make? And in that respect, Luxembourg is often at the bottom end of the list, because it's seen to be, you're paying a premium essentially to launch in that jurisdiction. And managers are really talking about Luxembourg fatigue today, because of that, the costs of doing business there. But having said that, I think these decisions will determine fitness for purpose, your speed to market, your longer term scalability. So whether you're bootstrapped or otherwise, this is an investment into the future of your platform success, and you really must make it a success. There are very varying fee scales for some of the Channel Island structures, some of the offshore jurisdictional structures, versus those which are in Ireland, in Luxembourg, as you'd expect as premium jurisdictions. But of course, you must be driven by your target market and their requirements, and less by what your overall cost base will be as a manager, because of that need to look to the long term and fitness for purpose.
Very quickly, anybody? I'm going to try and get to the couple of questions we have in a second, but anyone want to give a ballpark and in nanoseconds answer that question, that same question about costs, or should we just leave it with Ben? Gail, Paul, Steve? No. Okay.
I'll just very quickly mention, I had a client who set up in Malta, and it was a much cheaper jurisdiction. And I think it works for an incubator fund, or where you have a great nexus with the client and they don't mind where you're located, but they found huge issues in raising capital, and notwithstanding the fact that they were more expensive, had to move into a more regulated jurisdiction. So think about the long-term growth and distribution plan.
Funny enough, of our two questions, we have somebody here saying, what about Malta? And you've already unwittingly answered that question. Thank you very much.
They've got several billion of assets in Malta, like, in the tens of billions, versus I think 4 trillion in Ireland and 5 trillion in Luxembourg, right? So in terms of, if you are looking at a percentage, Malta has less than 0.5%, if even that, of the European funds market, right? And so there's just how familiar are institutional investors with it? How happy are they with the governance? How familiar? So as Gail says, if you have real ambitions about targeting sort of institutional investors with a level of due diligence that Ben alluded to, I think probably Malta is perhaps, whilst cheaper, is potentially a false economy. But certainly horses for courses, it's certainly fit for other types of funds with different target audience.
And we can always talk about specific pricing models offline. If anybody wants to reach out afterwards, then we can start to give ranges. But you are looking at your legal costs, your AIFM costs, your admin costs, your depository costs, where those are all relevant depending on the structures that you're implementing. So every line item has to be accounted for.
One thing I'd say there, Ben, on that is that you'll find, specifically in Ireland, you'll be a fixed basis point fee of assets under management when it comes to an AIFM or an admin or a depository. So in essence, it almost creates a commercial nexus between the service provider and the manager as well, to increase that AUM, because it's obviously working in both favors. So I think it does really create a strong working relationship between service provider and the investment manager.
Sorry, go on.
Yes, I was just going to add that, of course, above all of this, aside from independent costs, you've got to look at what the manager's potential for raising their own fees will be. And so the sensitivity around what a management fee and carry levels will be really depends on the asset class and the investment capability. And that can range anywhere from 75 bips to 2.5% for management fee, and carry, depending on the nature of the asset class, can be anywhere between 15 and 20, but I would say that there is fee compression even from a manager level, where 2 and 20 fee models are very much under pressure today, and it's important to assess that as part of your P&L consideration and judging the opportunity set.
It's probably worth
We are really out of time here. Gail, this is maybe an impossible thing for me to ask you to do. There is a question addressed specifically to you in terms of something you said about unless you can do it in about half a second, which we can get back to this person afterwards. It says, Gail said some overseas investors prefer unit trusts. How do they address the fact that those structures are liable for UK income tax? If that's not easy to answer quickly, and it probably isn't.
Well, what I'll just say is typically it's Japanese investors that we're looking at those type of structures. That's typically where I see it. So I don't know if that addresses the question, but I can address it separately. And if it's a tax point, I can check with my UK tax team as well. So if anyone wants to contact me after.
Well, thank you all very much indeed. Thank you for those who are still following us at this particular point. Thank you, Gail, Steve, Ben, and Paul, and Akarian for sponsoring this and putting this on. And we have, I believe, one more in the series to come. I think we're going to do that sort of midsummer. And we hope you can join us for that. We'll be writing some of this up in our publication FSI. As I say, we're going to be doing the research that I mentioned at the very beginning. But hopefully see you next time. Have a very good morning, afternoon, or evening, wherever you may be in the world. And hopefully see you again before very long. Bye-bye, everybody.
Thank you.
Thanks, Simon.